Hey everybody, I hope everyone is doing well and had a good day. In today's video, we're going to review the E-mini S&P 500 5-minute chart for Thursday, July 16th, 2026. As always, we'll start with the context on the higher time frame. This is the daily chart. The market's in a trading range, and it's had 3 legs up in a channel. So over the past maybe 15 bars, we've had a spike in channel structure, and we're at the top of a trading range. So the market's in leg 3 near resistance, and we had a trading range day yesterday. Probably sellers above yesterday's high if we get there. As far as yesterday's low, because it's a trading range bar, I would expect there to be buyers below, at least in the short term, but because it's 3 legs up to resistance in an overall trading range, it's possible that this corrects back down maybe to the start of this channel down here. Maybe this bear breakout, the tight channel, gets a second leg test of these lows in the 7,400 or 7,350 area. But as far as expectations for the day, I don't think we're going to fall maybe 200 points just today. So as far as in the short term with the trading range bar yesterday, there's probably sellers above and probably buyers below yesterday's low. Here's the 5-minute chart. The market gapped down going into the day and had a follow-through bar for the bears, so follow-through selling. The gap down, you can think about it as a bear breakout. So any trader, in theory, if they're buying the close of yesterday, bar 81, or buying below 81, buying below 80, buying below any of these bars, they are trapped by the bear breakout. Even if you bought at this support, you're trapped by the gap down on the open of the day and then follow through selling on bar 1. And that's good for the bears. The bears have trapped traders to the left. That increases the probability that the bears will get a second leg down. Two-sided bar with the big tail on bar 1, but bar 1 closing on its low is good for the bears. Like I said, gap down and follow through. So probably going at least a little bit lower. And bar 2, more follow through selling. It's a smaller bar, but another bar closing on its low. Good for the bears. Not much, or really not any buying pressure on the 5-minute chart, RTH chart, so gap down and a couple of bear bars. So hard to make an argument for buying here, so probably going at least a little bit lower. 3, we're getting more of a trading range bar, big tail, small body. The market's beginning to channel on the lower time frame, pulling back and overlapping the prior bar. And then more overlap, even smaller body, big tails on bar 4. So you can count, that's 3 legs down, 3 pushes down on the 5-minute chart. Very likely 3 legs down on a lower time frame chart. Expectation, a 2-legged correction. It is a bear micro channel. That's good for the bears, but the structure on the lower time frame is a hint that we may pull back soon. So selling down here, not ideal, but there's probably sellers above bar 4 and bar 3. And the micro channel will probably get a second leg down. And technically, the way I look at it with the gap down, the micro channel began on bar 79 yesterday. Bar 5 is breaking the bear trend line. That's good for the bulls, but big tail above the bar. In theory, any trader who bought the close bar, any trader who sold the close bar 4 is trapped by the bull breakout, and that increases the probability that there's disappointed, trapped bears and buyers below bar 5. And then an inside bar on 6. Now the bulls have a micro channel, not especially strong. It's a bear bar, doji, another doji, and then an inside bar. So really not all that strong, but probably buyers below bar 6 as the market has been going sideways for the past 4 bars. There might be sellers above bar 6, the micro channel down to 4, expected to pull back and then get a second leg down. And then we got a bull breakout bar on 7, a strong breakout bar closing on its high. That's good for the bulls. Any trader who sold above 6, sold above 5, they are trapped by the bull breakout. That increases the chances that 7 will get a second leg up. Also at this point, bar 1 is currently the high of the day, but bar 1, usually only remains the high or the low of the day about 20% of the time. So in general, it's a low probability event. Now the bulls have decent momentum, probably going at least a little bit higher. And we'll test the high of bar 1, which we get there on the next bar. Bar 8, another breakout bar, a little bit smaller, but good for the bulls. The micro channel continues to grow. We might pause here, but because of the momentum, the bears need a second reversal, so there's probably buyers below bar 8 and buyers below any first reversal attempt. So a small doji on 9, is that enough to sell double top 1 and 9? Probably not. It's a small doji bar after a bull breakout. It's a micro channel since 4, but trading range through here and then breakout and follow through. Good momentum for the bulls. Expect buyers below 9 and a second leg. And 10, another breakout bar. The micro channel continuing to grow. It looks like we have another higher low. And finally, a pullback as the market fell below bar 10. I said the first reversal attempt would probably be minor, and a minor reversal is a pullback, and that's the start of the channel phase. So the market is in the spike phase until there's a pullback. A bar goes below the low of the prior bar. Now the market's in the channel phase, so expect sellers above bar 11. 12, another breakout bar, but because we're in the channel phase, you can expect sellers above bar 11. And you can draw a channel line connecting the highs of bar 8 and 10, and that gives you a channel line where bar 12 is testing. It's also testing near the close of yesterday, which is resistance, because again, in theory, any trader buying the close of yesterday on the daily chart or buying bar 81 is trapped by the bear, the gap down, and the follow-through selling. So this is an area of resistance. Plus you can count 3 pushes, at least on the smaller time frame. 8, pause, 10, pullback, 12. So 3 pushes on a channel line near resistance. 12 is not an ideal bar to buy. And we're starting to go sideways near that resistance, but the channel up is tight, so the first reversal here, probably minor, a trading range bar, and then an outside bar. The expectation is that the channel evolves into a trading range. Because of that, there's a magnet at the low of bar 11, so that's a magnet for, that's an area for the bears to test. Think about it. After the spike phase, we pull back and enter the channel phase. In theory, any trader who sold below bar 10 or sold a low tick of 11, they're trapped by the reversal back up and breakout to a new high. So this area becomes support if the market gets back down here. And most of the time, channels evolve into trading ranges rather than breaking out in the direction of the channel. So in this case, a bull channel more likely to evolve into a trading range than break out above the channel line and rally for a measured move. So minor reversal was likely in the tight channel, but now at this point, technically we can count 3 legs up, 15 at resistance. So it's a decent looking bull bar, but not an ideal location for buying. There might be more sellers above. Bulls are taking profits above bars in the channel phase, and bears are selling above bars. Any trader who sold above bar 11, they may have been trapped by bar 12, but if they scaled in higher, they were given a chance to exit at break even on their original entry and with a profit on their higher entries. So the more this becomes two-sided, the more bears will be selling at highs and expected to make money. But at this point, pretty difficult through here to make money, or basically impossible to make money as a stop order bear. So it's limit order bears coming in here, probably above 15. 16, now we have a second reversal attempt. Bear bar closing on its low at resistance in leg 3. That's a reasonable bar to exit longs below. And for the bears, they have a reasonable stop order sell signal bar. 17, decent bear breakout bar, good for the bears, But the bulls see a two-legged pullback to support, two-legged pullback to the moving average in a swing. So rather than sell to close 17, there's a couple problems with selling here. I said limit order bears are selling up here. They're taking profits when the market comes back and tests support. It is a decent breakout bar, 17, but rather than sell at the support area, traders may sell a pullback instead. Maybe they sell above the bar. It's a bad stop order buy. It'd be occurring in leg 4 at resistance, but because it's a two-legged pullback to support in a pretty tight channel, it's not an ideal bar to sell the close of. 18 reversing up, strong bull bar, but bad context. Like I said, now it's leg 4 for the bulls at resistance, so the upside is probably limited, probably sellers above 18, as strong as the bar is. And then reversing back down, 19. Now the bears they're on their way down in leg 3. The bears still have that target, the bar 11 low, so selling 19 is probably okay for a scalp, but there's probably buyers below 18, but the buyers may not come in until the low of bar 11, which bar 20 gets to. So on the next bar, the market tests that area. We have 3 legs down to support, and the market bounces. Not a great stop order buy above 20. It's a doji bar, forcing you to trade in the middle of the tight trading range. Better to buy below the bar and better to sell higher in the range. It's a trading range, limit order market. Sell in the upper third and buy in the lower third. So continuing lower here in this channel, but now it's maybe a 4th push and a 3rd leg, probably buyers below 21, 22, bull reversal bar, good for the bulls. Decent signal bar to buy, still not ideal, not an ideal scenario to enter on a stop order, forcing you to buy in the middle of the trading range. But it is 3 legs down to support, and it's a decent signal bar. It'll probably get a 2nd leg sideways to up. One of the problems with buying here is the micro channel down to 21. There's probably sellers above 21. And the bears will probably get a 2nd leg down. Inside bar, tight trading range over the past 4 bars, continuing, but still reasonable to buy for a scalp. But if you are buying, you have to recognize it's a trading range, so you have to be scalping and sell in the upper third of the range. Remember the traders on bar 18. Remember how traders get trapped. In theory, there's a trader buying and selling on every tick. Any trader who bought the close 18, trapped on 19, they're disappointed, and this becomes an area of resistance. So 24 breaks out, but tests the upper third of this trading range and then finds sellers. 24 is a bad stop order signal bar for both directions. There's probably sellers above the bar and buyers below the bar, although the buyers may come in below the bar because support is a little bit lower. It's still sort of in the middle of the range. So instead of buying directly below the bar, traders may set limit orders some distance below the bar or using the bars to the left. And then a reversal bar, so we found buyers below on 25. 25 is a good-looking bull bar, but once again, right back to resistance in the upper third of the range. So good-looking bar, but bad location, bad context. At least 2 legs up, top of a trading range. Might be more sellers above. Small follow-through bar, 26, but still in that bad location for buying. The market's been sideways since bar 9. It's been in a trading range for almost 20 bars. So you have to ask yourself, do you really want to buy leg 2 at the top of a trading range? Probably not. Keep it simple. If it's a trading range, look to buy low and sell high. If the market's high in the range, better to look to sell. Outside down 27, good breakout bar for the bears. Probably will get a 2nd leg down. It's a bear breakout from the top of the range. But if you sell the close 27, you're entering sort of in the middle third of the range, which is not ideal. Maybe better to sell a pullback. Follow through selling down to the low of the range. Now we're back at support and the market bounces. But 28 after the bear breakout, it's a bad stop order buy. There's probably sellers above 28, and 27 will probably get a 2nd leg down. Once again, it goes back to trapped traders. Any trader who bought the close 26, disappointed. Just imagine if you bought the close here, and this is your entry bar and the following bar. You're very disappointed with your entry bar and what followed after you entered, and that creates resistance. So maybe you scale in lower. If the market pulls back, gives you an opportunity to exit at break even, you'll probably take it, and that's what contributes to the market getting a second leg in the direction of the breakout signal. So in this case, 27, the breakout signal, 28, the bad stop order buy. There's sellers above. Just in theory, if you, let's say you bought the close 26 and were willing to use a wide stop and scale in, buy more below 25. So you buy here, you buy more on 28. The purple line is your average entry price. And the traders who bought the close 26 are trapped and disappointed. And it goes along very nicely with the fact that 28 is a bad stop order buy. The traders who bought and scaled in, they may just look to exit at the purple line, their average entry. So they may look to sell, in other words, sell above 28 at their average entry price, which 29 tests. Now the bears are looking to get that second leg down, but the tight trading range continuing here, there might be more traders buying below 30 and probably sellers in the upper third of the range. 31, breaking below maybe 20 bars to the left. That's good for the bears. Breaking out and closing below these bars to the left. So think about what I said here. It was reasonable to buy below bar 30. Limit order market, buy low, sell high. But if you bought below bar 30, you're now trapped by bar 31, the bear breakout. And this may get a second leg down because of those trapped traders. Let's use the low of 22. This was the bottom of the range, and we can see what happened. So I'm calling it a trading range since bar 9, the doji. Market's been mostly sideways since then. Breakout below this trading range, below the low of 22. Closing below all those bars to the left in this trading range. And then look at bar 32. So in theory, maybe the limit order bull buys at the low of 22, trapped by 31, further trapped by 32, and then the market reverses back up and tests their original entry price. And this might be an area where the traders who bought 22, the market went against them, they're disappointed, they're trapped, and they use 32 to exit their position, and that creates resistance and increases the chance that the bear breakout will get a second leg down. It's also a micro channel since 29 to 32, micro channel with a micro gap. So the low of bar 30 and the high of 32 do not overlap. That's a sign of strength. It's trapped traders. Good for the bears. And the micro channel continuing down 33. So now we're breaking far below these bars to the left. Remember I said on the open, it's a micro channel since 79 down to bar 4, and it's likely to get a second leg. In this case, it got a deep pullback, but now the bears are looking to get that second leg, which brings us close to yesterday's low. And most days break out above or below the prior day's high or low. In this case, so far today, it's been an inside day. The blue line is yesterday's high, this blue line, yesterday's low. And since most days break out of the prior day's high or low, we're probably going either up here or down here. And this is now a bear micro channel 29 to 33. Expect a second leg down. And really hard to make an argument for buying here. The bears have decent momentum. They're controlling price and time. Another pause on 34. So it's a bear breakout, pause, breakout, pause. Maybe the bears get a third breakout. The market has this rhythm where it's breaking out and pausing, but the pauses are weak. They're not strong buying pressure, and they're not even triggering above the bar. The stop order above 32 did not trigger. The stop order above 34 did not trigger. That's a weak stop order buy signal against the micro channel, closing below its midpoint. It's a trading range bar. Expect sellers above anyway. Now it's a third push down. So we may correct here, and by that I mean get a pullback, but Micro channel down to 35, so expect a minor reversal and a second leg down. So 36, we're pulling back, but is 36 strong enough to reverse the micro channel? Probably not. Bulls get a reversal bar and then a breakout bar, 37. Now the traders who sold the close, 35, trapped by 36, further trapped and disappointed by 37. Now there's probably buyers below 37. Short term, expect a second leg sideways to up, so buyers below and a second leg sideways to up. But bigger picture, bear breakout, maybe a two-legged pullback, and then expect trend resumption, a second leg down. The breakout from the micro channel from 29 to 36 is stronger than 36 and 37. But in the short term, expect buyers below 37 and a second leg sideways to up. So going sideways here, still expecting buyers below 39 and an attempt sideways to up here for the bulls, which they start getting here. So we went sideways for a few bars, found buyers below. Bulls get a second leg. But now we're back at resistance, the moving average. The close of bar 32 is resistance. Remember, any trader, so in theory, there's a trader buying and selling on every tick, and any trader who bought the close 32, front running the bull breakout, maybe betting that the trading range would continue here and test higher in the range. These traders who bought are trapped and disappointed, and that becomes resistance. So as 41 breaks out, it's a good looking bar, but it's at the moving average resistance and it's approaching other resistance. And the bears simply see a breakout and a two-legged pullback. But this looks strong enough, bar 41, strong enough breakout bar that this may get a second leg up of its own. So maybe the bulls get three legs up here. Maybe the bears look at it as a wedge bear flag instead. Follow through bar 42, but much smaller than 41 and right at that resistance. Also the breakout point. Remember I said back here in this trading range, the bar, I was using the bar 22 low as the bottom of the range. So that's the breakout point. So in theory, a trader buys at the low of 22. They're trapped by the bear breakout. The market comes back and tests the bottom of that trading range. If a trader bought here, scaled in lower, they're able to avoid a loss on their first entry and make a profit on their lower entries. Incomplete structure, bear micro channel, no second leg yet. Two-legged pullback, but the second leg in the pullback is strong. It may need a second leg of its own. Buying directly below 42, not ideal. It's still closer to resistance, but there is a micro gap, so the high of bar 40, the low of 42 do not overlap. The high of bar 40 is probably a better support area to buy for a scalp. If you're looking to buy, you're scalping. You're trading counter to the direction of the stronger trend here. 43 tests that breakout point, the bar 40 high. Might have been strong enough that it gets its own second leg. This is becoming very fractal, you're getting these two-legged patterns on the smaller time frame, so it's more clear on the lower time frame. 43 is a bear breakout and a pullback in the same bar, and there's probably buyers below 43, which we get on. So traders come in and buy at the low or below bar 44, or bar 43 on bar 44. That's a second test of that support. I said strong enough breakout and follow through. It's a 3-bar micro channel, 40 to 42, that the bulls may get a second leg. Now they have a two-legged pullback, more clear on the lower time frame. But there's probably sellers above 44 as it's a third leg after the bear micro channel. 45 technically is a wedge. It's 3 pushes down, 43, 44, 45, and still at that support. So 45 might be a better bar to look to buy. It's possible that it's trend resumption for the bears. So bear breakout, two-legged pullback, and then trend resumption. But with all the overlap and the 3 pushes to support, the bears really need one more bar here to be more convincing. But it's always uncertain, especially in real time. You never know. This might be a wedge bull flag on the lower time frame. So bull breakout, 1, 2, 3 pushes down to support, and then expect another leg up. Or it might be bear breakout, two-legged pullback, endless pullback, and trend resumption down. In this case, we're finding support bouncing on 46, maybe a fourth leg down on 47. So you can draw a bear channel line here. It's still testing support, and 40 through 42 still has not had a second leg up, and 47 a smaller bar than 45. So bears losing momentum in a late leg on the lower time frame at support after a bull breakout that still needs a second leg. So again, it could be trend resumption down, but it's not ideal for selling until the bears get maybe one more strong breakout bar to be more convincing. And it's okay to wait for that confirmation, because if the bears are going to get a second leg down and a measured move, you have plenty of space to make a profit. So instead, we find buyers on the close of 47, 48, bull breakout bar. But what's the leg count? 37, pullback, 42, pullback, 48. That's 3 legs. You can draw the channel from here or here. Al talks about this in the video course. Sometimes the bull move starts before the bear move ends. So you could draw the channel beginning from bar 34 or 37. Doesn't really matter as long as you recognize that bar 48 is a third leg in a channel after a bear breakout. So 48 really not an ideal bar to be buying. It's near resistance in a late leg after a bear breakout. Bears see wedge, bear flag. Bulls are probably just hoping we break out above the bars to the left and test higher in the range. But this micro channel cannot be ignored. This is a pretty strong selling down to 35. And it's likely to get a second leg down. And we can see the reaction. Remember the trapped traders from earlier? The breakout point back here, the market tested it on 42 and we found sellers. We're testing it again. Expect sellers. Probably sellers above 48. And then 49 reversing down. A lot of overlap on the bar, but it's a stronger bar than any of these bars. It's similar to 45, but it's bigger than 45. And it's more, maybe you still need one more bar to confirm, but now the bulls have that completed structure. They have that micro channel. They got its own wedge bull flag and second leg. And now 49 might be that trend resumption down. And then 50 can confirm that the bears are getting a strong breakout and follow through. 49, 50. Bears looking for a second leg down and a measured move, which brings us close to yesterday's low. So I'll keep that as the magnet, as the target. Probably sell the close 50. Good structure for the bears. They have this tight channel down to 36, a pullback, and now possible trend resumption. And if it is trend resumption, it's also possible we fall for a measured move based on the height of this flag, which brings us below yesterday's low. So I said sell the close 50, 51, still sell the close moving. It's a 3-bar micro channel with a bad stop order, buy above 51. So sell the close, sell above. First reversal, probably going to fail. So period of breaking out. Then we have 3, 4 bars sideways. Expect at least one more leg down after this micro channel. With the bigger picture, second leg measured move at around yesterday's low. Another micro channel down to 55. So expect at least the bulls need a second reversal. So okay to sell here, sell the close, and sell above bars. 56, bad stop order buy, sell above the bar. Sellers come in. Now at this point, you can count 57. If you're selling below 57, that's a third leg. 1, 2, 3. There's a bear channel line. There's support at yesterday's low. So there might be more traders buying below 56 here as the channel progresses. The channel down is tight, so expect a minor reversal, but because it's entering a third leg in a channel, you can expect a pullback. 58 bull reversal bar. Good for the bulls, but on the bear trend line, So not really breaking far above the trend line in this channel. So far, it's a good bar for the bulls, but probably not enough to reverse the tight channel down. We're close enough to yesterday's low. We're probably going to get there. Breakout bar, but weak bar. It's closing below its midpoint. It's a relatively small bar testing resistance. Might be strong enough up here that there's buyers below and a second leg sideways to up, but ultimately still expecting this to be a minor reversal and for the tight channel down to 56 to get a second leg down. And then bar 60 closing on its low. So it's really difficult to trade against the trend here when you're getting a bear bar closing on its low. You have to ask yourself, is it worth looking to buy here for a scalp counter to the direction of the trend? 60 is a reasonable bar to sell below and sell the close for a test of the lows. Now it's a 3-bar micro channel with a micro gap. Sell the close, sell above 61. Reasonable. Micro channel continuing to grow. So okay to sell and scale in higher. Probably sellers above 62. Another reversal bar. We're finding some profit taking at yesterday's low. Once again, you can see 3 legs down in a channel, but the reversal bar 63 not strong enough to reverse the entire channel. It may get a second leg sideways to up, but micro channel from 59 to 63, probably sellers above 63 and a second leg down. Resistance at breakout points to the left. Another bear bar closing on its low. Difficult to buy below that bar. If anything, the market's probably going lower. There might be buyers below 63 because we're in the channel phase and bears will take profits at new lows. The bulls end up getting a second leg sideways, 67. So reversal bar 63 and a breakout bar 64, pulling back and then a second leg sideways. But imagine the bulls who bought the close 64, disappointed and trapped by 65. Market comes back and tests that price, 67. There's probably sellers above 67. And then the market continues lower. Approaching the bear channel line, there's probably profit taking, buyers below. But the channel down is tight. It's difficult to make money buying here. So probably buyers below 63, bears taking profit, but to buy, to go long is not ideal. Probably sellers above 69. It's a bad stop order buy. 70, same thing. Bad stop order buy. Minor reversal more likely. And the channel continuing down. Another reversal and follow through in the direction of the channel, but we are on support, the channel line. So not an ideal location for selling here. Market breaks below the channel line 73, another 3-bar micro channel. So expect the market to need a second reversal before reversing this micro channel. So in other words, expect a second leg down. Probably okay to sell here, but because it's on the channel line and far below the moving average and late in the day, it's not ideal. So reversal bar 74, but because of the micro channel, there's probably sellers above 73, and the bears will probably get a second leg down. And the bears get that second leg down, 75, 76. Once again, it's late in the day, and obviously testing that bear channel line. Something else I noticed that's interesting, it's easy to miss this, and there's many little things that I definitely do not mention in these reviews, but this is one that I wanted to talk about. Micro channel from bar 4 to bar 8 for the bulls, and they get a channel out of it. It's mostly sideways, but basically it's a spike and attempt at a channel sideways to up. But this micro channel to bar 10 or bar 8 did not reach a measured move target. And when a micro channel, when a breakout like this fails to reach a measured move target and reverses, it can go for a measured move in the opposite direction, which we can see the market testing here. So I just wanted to add that. I think that's interesting. 77, a big breakout bar, so a surprising bar as the market tests. Who knows? I mean, that's one area of support. We talked about the bear channel line support. It's late in the day, so you might get some profit taking, but big breakout bar, have to expect that bar to get a second leg sideways to up. It's a big breakout bar. And it's disappointing, all the bears who sold above 76 or 75. And then a follow-through bar, but a smaller bar, 78, but pretty decent breakout here for the bulls. It's testing resistance. So we may pull back here, but I expect the market to pull back, but then to get a second leg sideways to up. The market's probably in a trading range at this point. As the channel evolves into a trading range, the bulls got a strong reversal, and I have to expect that the bull breakout trapped a lot of traders and is strong enough for a second leg. But of course, very late in the day, so we're not going to see it in the RTH chart, but the market pulled back here in the final few bars of the day. That's going to be it for today's end of day review. Thanks everybody for watching, and for more price action fundamentals, please visit the brookstradingcourse.com. There's a link in the description of this video. Once again, thanks everybody for watching, and I hope everybody has a good night.